Hello again, everyone. Welcome back. In this technical analysis of the stock market video, I call it Season of Pain because that's exactly what we're in when you have the major indices down for 7 and 8 weeks in a row, and you have stocks like Walmart having their worst week ever. All right, we're going to start off and take a look at the side-by-side view, the Dow, the S&P, and the NASDAQ like we usually do on a weekly view. And then we're going to take a look at the S&P, drill down a little bit more, look at the daily, look at the Elliott Wave picture, look at one of our indicators, our equity put to call, and see if that's giving us any kind of reading at all. Take a look at the ETF Dashboard and drill in and take a look at 3 of the big movers for the year. XRT Retail, Consumer Discretionary XLY, and Energy XLE. So let's get started right here. This is the Dow. It was down 935 points this week for the 8th week in a row. The S&P 500 was down 122 points for the 7th week, and the NASDAQ Composite down 450 points for the 7th week in a row. Pretty dramatic. Now, last week I talked about how this candle right here was a hammer, okay? And it's a classic looking hammer. It was really it's almost perfect. Perfect, except for the fact that, in my opinion, it just failed this week because we really didn't get any follow through. Now, it would be worse, and maybe we'll get a close below the low. It would be worse if we would have closed below that low, but we did break down below that low and got no follow through to the upside. So it'll be interesting to see. We may get some kind of bounce in here after being down 7 weeks in a row when you'd think you're going to get some kind of a bounce. But the same thing happened over here on the Dow Industrials. Had the what looks like a hammer, not quite as picture perfect as the S&P 500, but neither one of them worked. Okay, so we're in a bear market right now, and this it gets very relentless. All right, let's go back and take a look at the SPX on the daily. Here's the same weekly we were just looking at. Here's the daily view. Let me just go to this right here. So here's the trend that we got down. This is like a channel. We're breaking down out of that channel. That's exactly what I typically look for when we're in a third wave like we are in right now. So we've had the first wave down, second wave back up into the high in March. And now we're in the third wave. I don't believe that third wave is complete. And within this third wave, what I've got labeled as the third minor wave, okay, I'm expecting to see 5 waves that do not overlap, impulse wave structure for wave 3. You can't have a diagonal or ending diagonal or anything like that in a wave 3. Okay, so right now, I just don't see this as being complete yet. And so I believe we're continuing to work our way down in a third wave of a third wave. If I had to put a target out here as a normal length wave 3, I'm looking at it at 34.98, which that's the path forward. So we'll see if we continue to get the wave structure that we need to see in here for a wave 3. So that is the Elliott Wave picture that we've got on the S&P 500 right now. Let's take a look at the put to call ratios. Let me pull that up. So we had on Friday 88 puts for every 100 calls. Now we're getting there. I mean, it's definitely starting to increase in terms of the level of put buying, but the 10-day moving average is over here at 0.76. Again, I don't color code this as any kind of extreme reading until we get a lot higher. And let me just give you an example. Let me pull this up. This is January 2008. This was the third wave of the first major wave down, okay? We had this bottom in January. This is the kind of extreme put buying that you need to see for an intermediate bottom. Then we bounced into February, the end of the last half of January, into February, and then we came down and formed a even more extreme selling, even more extreme put buying, and finished off minor wave 1 in March of 2008. So this is the kind of look that we just haven't seen yet. So We're keeping our eyes out, and there's several other indicators that we watch on a daily basis, and we're just not seeing the capitulation, the extreme selling yet. Okay, so that is the put to call. Let's take a look at the, I want to take a look at the ETF dashboard. Okay, here's my ETF dashboard, or at least a portion of it anyway. For the week ending May 20th, this was dated Saturday, May 21st, which is today. And so I have 16 sectors up here, the 11 major S&P sectors, and then some subsectors in here. And then we've got some major indices, plus I've added in this transportation ETF because we really don't have an ETF in here. All these are ETFs. We don't have an ETF that's mirroring the Dow Transports that I'm aware of. And so I'm using this as the closest proxy for that. So when you look here, there were 4 sectors up and 12 down. Last week there were 2 up and 14 down. And the worst performer, retail, down 9.4% for the week, but right on its tail, consumer staples, mainly because of Walmart, I believe. And well, they hit P&G too. I mean, so when Walmart got hit the way it did, they're looking at it and saying, oh my gosh, so these stocks that are pretty stable, relatively stable stocks, and that people kind of move to for safety, well, they're getting killed because of their costs going up dramatically, the supply chain issues, etc., and they don't have any great visibility out into the future. So here we are with consumer staples down 8.1%, and consumer discretionary, this was heavily influenced, I believe, because of Target, but there's a lot of them in here that are getting killed, down 7.8%. And then when you look at the year to date, of course, the big performer is energy, and biotech had a pretty good bounce this week, so I didn't want to ignore that. But energy is the big leader to the upside for the year. The only other thing that's positive, ever so slightly, it's basically break even, is utilities. All the other sectors are in the red pretty dramatically. And so right on retail's heels is consumer discretionary and home builders. And then we've got several others that are well over 20% down year to date. Okay, XLC, and we look down here, NASDAQ Biotech, semiconductors, XLK, and telecom. So a lot of damage. It's definitely the season of pain. There is no doubt. And when you look at what happened here in the indices in this area, the transportation average was the weakest, down 5.2%. It is definitely, the Dow Transports have definitely broken down out of a major head and shoulders top. And then, the one that's been the weakest all year, of course, is the NASDAQ 100, and it's down 27.4% for the year on the QQQs. Okay. So that is the ETF dashboard. Let's take a look. I want to take a look first at XRT. Okay, XRT was down $6.39 this last week. This is a weekly chart, and I'm just showing you basically about the last 3.5 years or so of data right now. So here's the March 2020 low, $26.29. The high that occurred back in November of last year, 104.31. And the intra-week low that happened just this last week of 59.26. Now, if I had to sit back and say, well, where is support in here? I put a dotted line that I think that we have a potential support area right in the middle of this cluster, which kind of lines up with the highs over here, August of 2018. And what is that? If I had to ballpark it, I'm saying 51.5. 51.52 is what I've got labeled, but 51.5. is where I would think, as we continue to push down, that we ought to get some kind of support kicking in. I don't see anything until we get into this area. All right, let's take a look at Walmart. Okay, I know this has been all over the news and everybody was talking about it, but this was down 19.5% last week alone, down $28.85. I don't have the data, but what I've read, my understanding is that this was the worst week ever for Walmart, worse than the October 1987 crash, worse than anything that occurred in the 2008 financial crisis, the worst week ever for Walmart. And I don't know how long Walmart's been trading, but I think it's been trading for a long, long time. maybe back into the 70s or so, and I don't know, maybe even earlier, not sure. Okay, let's take a look at consumer discretionary. Okay, here's the picture on XLY. You can see the March 2020 low, 81.74, the high back here in November of last year, 215.06. And yeah, we are down dramatically. The low last week, 136.03, down $11.91. So, you know, definitely hard down. This does look like it's in a third wave down. We're into an area that I would say is a support zone in here between 139 and 141 and 3/4. It looks like a support zone. Now, if this doesn't hold, well, then you get back down into a lot further. So, you know, you just start, you know, stair-stepping it down in terms of where potential support would be. But right now, this looks like the strongest in here, and that's exactly where it closed. It closed right in the middle of that support zone at 140.41. So that is the picture on consumer discretionary. Yeah, we're getting a little oversold. You can always get even more oversold, just like you can get even more overbought on the upside. All right, so let's take a look. I want to take a look at Target. Okay, so here's the picture on Target, down $64.37 last week, 29.3% in that week alone, but pretty dramatically down from the high that occurred in November, the week of November 14th, 268.98, the intra-week low 150.89. So that is off. What is that? It's about not quite 50%. 50% would be about 135 or so. So yeah, potential support in here. If it doesn't hold in here, you know, it's a big move. But if this doesn't hold, then you got to start looking at, well, where else are we going to get support? Down here to 129 into this area of cluster of trading that occurred down here around 118. Now, I mean, it's just right now, there's not a whole lot of strength below this, but you know, when you get this kind of a huge move in here, it wouldn't surprise me at all to see it chop around for several weeks. So that's the picture on Target. Now I want to take a look at, to the upside, let's take a look at XLE. Okay, Energy Select Sector Spider ETF, XLE, pretty solid uptrend. The high last week, $84.57. The low in March 2020, $22.88. Now we're up almost 4 times the money, almost. Okay, so what is this dotted line area here? To me, this is a resistance zone that it attacked. Look at this, 1, 2, got repelled a second time. Third time, we've gotten up above it. We've traded up and through it a couple of times, but now for the most part, we're closing and trying to stay above it. We'll see. We are getting some divergence on the RSI, getting divergence on DI+, but this is a zone that relates to the highs that occurred here between December 2016 and into 2018, the highs that occurred. And so it's trying to hold above that. And if it continues to do that, I could see it pushing and going up and, you know, testing these highs up in here around 100 or so. But right now, it's acting very, very well. So that is the picture on XLE. That is the strongest performer. Remember, we talked about it with the ETF Dashboard, up 47.33% for year to date. Okay, that's it for today and for the weekend. If you felt like the video was helpful, give it a thumbs up. If you're not a subscriber to this channel, hit that little subscriber button. And there's a little bell you can click on too there to get notified when I do post a new video. And if you'd like more of this kind of information on a daily basis, head on over to joehenches.net. Check out the website, check out the membership. Everyone have a great rest of the weekend and have a great week.